This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 17th. Some highlights from today's show. The S&P 500 posts a bullish close. The rates markets don't actually see a recession. And the US Fed is now in focus. A good day, traders, and welcome to another week of trading in the futures financial markets. Let's get stuck straight into it, talk a little bit about some of the overnight market moves in Europe. It's been a very, very quiet session. I think that's a good way to think about it. This is not necessarily something that's new. We started seeing this actually on Thursday last week. We started seeing the vol just compress a little bit, as well as the volumes, importantly, sort of come off quite a bit. Now, again, that can be down to a number of things. Perhaps market participants are a little bit fatigued by all the sort of the news flow that's going on from the Trump administration. But also keep in mind there is a role to contend with. Okay, we are seeing the role now in the US indices, and so the markets are contending with that, of course. So once that gets through, maybe we see the volumes pick up a little bit later on this week. Also, don't forget we have got a couple of key risk events this week, including, of course, the Fed on Wednesday. So typically what we do see in a week where we have these big central bank meetings is volumes do compress a little bit. Everyone sits on the sidelines. We get the risk event out of the way, and then volumes pick back up. So that is very, very important, because I think that's going to play into very early on what to expect this week in terms of opportunity scope. Okay, with that in mind, let's turn our attention and get on to our first topic of discussion. This was from Scott Bessent on the week, and I think it's a fantastic way to understand what exactly is the Trump administration trying to achieve in the present day. What are they actually trying to do? Because there's a lot of backwards and forwards on Wall Street as to, are they trying to purposely slow their economy? Or do they want a recession? What is it ultimately they're trying to achieve? Do they want lower yields? Etc., etc. Now, in reality, I think ultimately what Scott Bessent is telling us is that they just want to do a bit of rebalancing. Okay, now the way to think about this is where he says the top 10% of Americans are effectively 50% of the consumption. Okay, now don't forget the US economy is heavily driven by domestic consumption. So when only 10% of Americans make up 50% of the consumption, long term, that's not a great strategy. Okay, that invites in a lot of volatility. And importantly, if you think about the US or the Trump administration, ultimately they are a populist type movement, and ultimately they got into power because they were going to help out that other 50% of the population that isn't doing so well. And so ultimately what they look like they're doing is they're happy to see the stock market come off a little bit. Don't forget the S&P has posted 2 significant back-to-back years of really, really good gains. But in reality, what Bessent is telling us is that now must come to an end. It's not that they want to create a recession, but they don't want to see these sort of, significant outperformance in the stock market when, the average man on the street is not doing so well. Now, I think the key point out here is this last part where he talks about a detox period. And I think that matters because I think what we're going to ultimately see is a lot less support from, the US government side of things. They're not exactly going to be promoting record high stock market movements. Sure, if they do come down the line because of good policies, because, growth ramps up, fine. They'll accept that as sort of a byproduct, but they're not going to openly actively promote this. Okay, and I think that's key because what it means is that this idea of perhaps double-digit 10% returns in the S&P may be difficult to achieve this year unless for some reason we do get a growth spurt for whatever reason it may be. Okay, and I think that's a good way to start to think about this year. If someone sort of said to me, Brian, what do you think ultimately the US stock market does this year? Well, I think we'll get a lot of volatility, but net, I think we could close the year unchanged. Okay, I think we could have small upside, small downside, but ultimately we go nowhere and we just have a lot of volatility. Okay, and that is theorized, or in terms of the thesis, that's based on the fact that I don't think we get a recession, and in fact I think all we get is just a revision of some of the very, very good growth numbers we had at the start of the year. Okay, so rather than having a 2.3% GDP for this year, perhaps we only get 1.5% or somewhere between 1 and 1.5%. Okay, and that's not so bad. But ultimately, don't forget, we came into this year where the market was expecting another really good year in terms of growth. Okay, now in terms of the chart, I think this is a good chart because this is consumer discretionary. I think I took this from the Market Ear this morning. They were talking a little bit about how, it's consumer discretionary now that is going to ultimately determine whether or not we have a very big slowdown in the US economy or not. Okay, and that's why I think this is a chart that's very important to keep an eye on in terms of a proxy, because if we see consumer discretionary, continue to drop off very aggressively, well, guess what? That is ultimately going to increase the odds of a US recession. Okay, this is not a case of we're in a recession. I don't think that's the base case. There's obviously a number of different banks on Wall Street that are talking about 20% chance of recession. Nomura is talking about 50% chance. The reality is no one is conclusively saying we're in a recession. Okay, the odds are rising, sure, and I think that's why this is the chart you have to pay attention to. If consumer discretionary keeps selling off, it's telling you the consumer's sick, and if the consumer's sick and they're going to stop spending, well, yes, we are going to see the US economy perhaps stall, perhaps maybe we get very low growth, and if it gets really bad, then yes, perhaps we do get a recession. But there's no point in betting on a recession because the odds of that and the probability of that is still relatively low. Now, I think one thing to pay attention to on this chart is if you go back to look at last year when we had that growth scare, okay, July, August, we got quite a big sell-off in consumer discretionary, okay, call it 13% in 14 days. Now it looks very similar because we had a 15% correction in 16 days over the course of the last 2 to 3 weeks. So a very, very similar pattern play, but what I want to point your attention to is look at the speed of the rebound. Okay, we're talking about 14 days later, effectively retraced the entire move. A nice V-shaped reversal. In other words, as quickly as the recession got priced, or at least as quickly as the odds rose of a recession, they dissipated just as quickly. Now, the question mark for us is it going to be the same this time around? Okay, we've come into that 200-day moving average. Is it going to be the same this time around? I don't know. Okay, it's anyone's guess. Scott Besson has just told me, well, look, 50% of consumption is coming from 10% of the population. We know that 10% is the wealthy population. We know they invested in stocks, and we know stocks have lost a couple of trillion in valuation over the course of the last 2 to 3 weeks. So are they going to spend in the same way? I don't think so. So I don't think consumers discretionary completely rebounds, but again, this is why it's the proxy. We pay attention to it. If it does rebound, guess what? Stock markets will be at record highs at some point this year. If it doesn't rebound, if we see a lot of two-way trade now over the course of the next 2, 3, 4 weeks and then a continuation, guess what? Watch out, because we are going to see a continuation of this souring narrative, and perhaps the odds of a recession start to rise. Okay, now with that in mind, let's talk about University of Michigan. That was out on Friday. Absolutely smelly print. And again, I did post this in terms of the market rundown. I said, watch out for that miss in consumer sentiment. Why? Well, because consumers tie a lot of their confidence on their 401ks. Okay, the reality is we saw the exact same thing in July last year, which was when we saw that significant slowdown in the stock market. Of course, sentiment went out the door as well. So this, I do expect, will continue to move lower over the course of the next couple of prints. But the key takeaway was not only did we see a souring in the sentiment, we also saw the inflation expectations tick up. And that's going to be important because guess what? The Fed is coming out this week and they're going to have to update us on their forecasts. Keep an eye on the University of Michigan. It is one that ultimately is driving some of the concern on Wall Street. Now, with that in mind, I said this on Friday, the Mag 7 is the one to watch. Why? Because the Mag 7 ultimately was the one that topped out earlier this year with DeepSeek. The Mag 7 is ultimately where the weight of the market sits, and the Mag 7 is the one that has now staged a very good correction. Okay, pick your Mag 7 favorite. They've all had a very decent correction now, and we can see that the ding ding ding, the number one Nvidia, has now started to rebound. Okay, not only did it stage a very strong week last week, it also started to bounce ahead of everything else. So it is a proxy this week for sentiment. I do expect Nvidia will push a little bit higher, back up towards that 127 level. We've been talking about that for a number of months now. It seems to be a very, very important support at the start of this year, and now it's turned towards resistance. So don't be surprised to see us get up there today / tomorrow, particularly because sentiment has turned a little bit. There is quite a little bit of chatter of buying up some discounts that are now available in a number of the Mag 7 stocks. But again, I think the key this week is to watch whether or not this Mag 7 stage is a good week. Okay, we can see Mag 7 was down relatively heavily last week. I suspect we see a little bit more of a positive this week, and I think how we close on the weeklies is going to define, of course, the rest of this month and moving into April month. So keep an eye on the Mag 7. Now, turning our attention to the VIX, we've been talking about this for a couple of sessions. We can see it continues to crush a little bit lower. And that's ultimately where I think the positive sentiment is going to come from. People will be a little bit more willing to dip their toes in and perhaps buy up a couple of Mag 7 or even the indices. So I do expect another day of positive trading in the S&P 500 and NASDAQ, Russell, and led by a number of different things. Okay, I think it's predominantly going to be led by the Mag 7, but like I said, keep an eye across the board because sentiment is turning a little bit more positive. Of course, I don't expect us to fly up the page 3, 4, 5%. It is going to be a slow grind type move. So like I said last week, it's very much about buying into any kind of weak selling. With that in mind, VIX levels, I think this is a massive level here around that 21 area. We can see it's held as resistance earlier in the year. It's now holding as support. If we get in below that, again, that's just going to fuel more buying in the market. Don't forget, a lot of the CTAs started selling the market last week. So not only did they go from being mega bullish, they've now wiped out all those bullish positions and actually started to sell the market. So again, how low the VIX goes? Well, look, I don't think we are going all the way back down to 15, 16 anytime soon. The narrative of a weak outlook does not shift that quickly. So I do expect we are going to see the VIX remain above this, sort of 18, 19, 20 level for some period further. So watch that VIX, because once that VIX does turn and start to bounce again, I do suspect we'll have some sell side opportunity in the indices. Now, it's all about the Fed this week, and I think I'm not going to go through this in great detail. We'll talk a lot about this on the Wednesday stream. But the thing to look out for from the Fed this week, besides all the dot plot projections and the growth forecasts and the updates on inflation, the most important thing that investors want to know is, will the Fed have the markets back? Okay, is the Fed focused on inflation or growth? Now, the theme for 2023 and 2024 was the Fed was going to prioritize the labor market. Okay, that's what they told us. But we are now seeing inflation expectations ramping up. Okay, we are now seeing a concern around the growth side of things. So which is it that the Fed's going to prioritize? Are they going to prioritize their inflation mandate and get back to 2% next year? Or are they going to prioritize growth? Okay, they're going to have to pick one or the other at some point. And I suspect that's what investors want to know. Because if they prioritize ultimately inflation, what they're telling us as investors is they do not have the stock markets back anymore. Okay, and that will scare the living shit out of the stock market, because right now the stock market doesn't have President Trump's back. Okay, the point is if we don't have the Fed giving a little bit of a positive sort of, we will step in if things deteriorate further, the reality is the market's going to scare on that. Okay, because it just means that, the traditional pillars of support are not there anymore for the stock market. And like I said, sentiment is fragile at the moment. So anything from the Fed along those lines, if they prioritize inflation over growth, equities will stage an offer. Of course, if they come out and tell us, look, we're a little bit concerned, and of course, we are still very, very tight. We can cut a little bit quicker if need be. Any hint of that, and guess what? The stock market's absolutely going to love the fact that the Fed still has their back. Now, with that in mind, I put out a tweet about rates markets do not see a recession, and they obviously don't. Okay, and I think that's why you have to be so careful reading Twitterverse and all the recession calls and blah blah blah. The reality is that right now, the rates markets are pricing a little bit of a slowdown. We see that since sort of mid-Feb, we can see those rates markets all started pricing in a little bit more chance of cut. But if we look like quite far out, so we go all the way sort of, midway of next year, the markets are only pricing in around currently 75 basis points of cuts. Okay, now if we go back to the start of the year, they're pricing in around 50 basis points. Now they've priced in an additional one cut. So it's not like the market is concerned at all. It's just pricing in one more additional cut. And this is at a time when we clearly are seeing a revision of growth expectations. Okay, but the point is that the market sees it as a slowdown in growth relative to, the very, very strong growth expectations we had, rather than a recession. Okay, if we had recession pricing right now, we wouldn't just be pricing in 3 cuts. We'd be pricing in not just 3 cuts, we'd be pricing in perhaps 6 cuts, but also bringing forward those cuts. Right now, the market is doing neither. It's pricing in 3 cuts out to the middle of next year, and most importantly, it's not pricing anything in the near term. Okay, first cuts are only expected to come after the summer. Right now, there's absolutely no fear of recession in the rates markets. Now, in terms of levels going into this week, I think the S&P is going to be a very good one to trade. Like I said, I think you have to be bullish given the close on Friday, given what the VIX is doing, given what the Mag 7 is doing. There's a number of signals pointing towards a very good session incoming for the US market. Like I said as well, volumes are light. It's not going to be necessarily easy to trade. You don't want to be buying top ticks. We definitely look like we're going to go and retest that weekly high around that 56.73. But in terms of where this gets to, okay, in terms of where would I turn and sell this, or where do I think those sellers might come into the picture, I think there's one little area that's very, very interesting, which is somewhere in this block over here. And I'll show you a profile of this in a minute. But somewhere around that 5,800, I think we are going to get there either today / tomorrow. I think we'll get a little bit of a squeeze when we get above those 56.75s. And once we are above that Friday, last week's I think it was Tuesday or Wednesday's high. Once we get above that, I do expect we're going to make our way up towards that 5,800 pretty quickly. Why? Well, because we've got a low volume area sitting effectively just around that 5,700. What does that mean? Well, if we look at it in terms of time spent trading in different areas, what we can see sort of at the start of last week was we spent a lot of time distributing somewhere around that, call it 57.20 up to 58.40. Okay, we can see the market had really good resistance up here at 58.75. I mean, that is a significant level for the market, and so long as we're below that, the market remains technically bearish to the downside. We get above that, everything flips, and this market will stage quite a significant rally. But the point is that we've got two very defined distributions. We spent most of last week in the lower end of this distribution, just trading out between this 55 and 56.50. We obviously now have this low volume area between the two. In other words, it's an area where the market has not transacted. Now, when we move from value area to value area, the market does not have to sit around. So effectively what I expect is quite a fast move back up towards that 57.60, and I expect the market to sit inside a 56.60 up to a 57.60 range for most of this week, of course, until we get to that Fed late on Wednesday evening. So that is, for me, how you play the S&P this week. You don't want to be buying it too aggressively. You want to buy into weak selling, and equally, you don't want to sell into any kind of a rally too early, because I do expect it'll extend itself, just given the positioning of the market, given a little bit of positive sentiment is coming back into the markets. All right, that is, of course, then a wrap for today. As always, if there are any other questions, do post them in the Discord channels. And our question for today is, what markets are you going to be trading? What is your opportunity today? What do you think is going to be the easy money play for today? Post them in the comments box. It's always good to see other traders' thoughts and opinions as to how they feel they can take on certain trades. Otherwise, of course, as always, make sure you're managing that risk. Good luck out there. Go make some money.